Hi everyone, this is part 2 of question 2 in the Practice and Revision Kit, Charlie and Susan. This will deal with the answer. Now, we know that part A of the requirement simply asked us to detail which element of the termination package was taxable. And really what that means is that we've got to look at each of the elements individually, and classify them. Okay, now there's a couple of different rules that we need to remember, and perhaps a couple of different phrases or words that we need to be familiar with. The main one is just this issue of contract of employment. In other words, whether or not the individual item was per contract of employment. If it was, then it is taxable. In other words, it is to be included in the income tax computation immediately as taxable pay. Okay, there's no exemption whatsoever. That's the first one. So any of the items that we can clearly see are per contract of employment, we take directly to the income tax computation. And there is one that we can see really straight away. I'm not doing these in order, but you'll see that holiday pay, is taxable as salary. In other words, holiday pay would have been detailed within the contract of employment. In other words, when the individual's contract of employment, Susan in this case, was drawn up however many years ago, 21 years ago, I think, that holiday pay was detailed in the contract of employment. And because it was, the revenue are saying, well, we're sorry, that's definitely taxable. Okay? Now, in addition to that, the other word or phrase that we need to be familiar with is this word, ex gratia. In other words, if a payment is ex gratia, that means that it's voluntary. That means that the employer has decided at the point at which the individual became redundant or they're making them redundant, well, listen, we'll give you a break. We'll provide you with this particular item as an ex gratia payment. And if the item is ex gratia or voluntary or perhaps unexpected, then that item will be included as what we call a taxable termination payment. In other words, that will be part of our partially exempt group. Partially exempt. So that ex gratia compensation payment of 38.7 is to be included as a taxable payment. Now, the other thing here is this loan amount written off. Now, they didn't say ex gratia, but if you think about it, if the individual has a loan with the company, in other words, the company has lent the individual money, if they simply decide at termination of the employment to write that off, that sounds to me as if it's a voluntary or ex gratia gesture. And because of that, that is also part of our taxable termination group. So it looks to me so far that we have really two items that are part of our what we call our partially exempt group. The last group, and invariably the only one that they put in that group is the exempt group, we call it, is this statutory redundancy. In other words, that's our third group. That is exempt for tax. What does that mean? Well, what that means is that it's non-taxable. Now, what I would do with that payment, just to make sure the marker knows that I know my stuff, is that I would include it in the income tax computation, but just say exempt or non-applicable. So really, in summary, as I see it, where we have a termination situation, we're either going to be including the payment, as we've just suggested, with the statutory redundancy as exempt, or it's going to be partially exempt, or 3, it's going to be fully taxable, So there's only really sort of 3 choices for us, and it's our job to really include each of the items here in one or other of those groups. Now, the key issue for us, and this question, or indeed this answer, is not laid out particularly well. The key issue for us is where we have this partially exempt group, i.e. this one here, once we have the figures for that, which in fact is 44,200, what we need to do is then say, right, well, these payments are partially taxable. We need to apply our three exemptions. Our three exemptions: the basic, the increased basic, and the SCSB. Now remember that these calculations, or indeed these formulas, are available in your study text, in your tax tables. There's also a tax table in the practice and revision kit. So you will have those exemption values, or at least the formulas, in your exam. So if you can't remember them, you can go straight to them. So what do we need to do? Well, basically, we need to calculate the amount of the exemption, the highest exemption. The first thing that we do, and this is where some of the information in the question becomes handy, is we look at this first area of the basic exemption. The basic exemption is just absolute figures. 10160 and 765 times the complete years. Now do remember that it is complete years. It's not part years, and that's a typical trick that the F6 examiner is going to play on you, and indeed the P6 examiner as well if you happen to go for P6 advanced taxation. It is complete years. Watch for that. Now, other than that, this one here is just a basic addition and multiplication. There's nothing much to it. What we get is a figure of 26,225. The next thing that we do is we go to what we call the increased basic. Now, the increased basic, as you should remember from your studies, is just really £10,000 added to the basic exemption. But it's subject to two main conditions. Okay, the first one is that there hasn't been a termination payment, or indeed a claim for termination payment or a tax-free payment in the previous 10 years. Now, we were told that in the question. In addition to that, obviously, or linked to that, is just this idea of the tax-free lump sum. The other issue is this idea of the present value of the tax-free lump sum payment on pension. In other words, what you would have to do in a real-life situation is to get your finance department to calculate the present value of your tax-free lump sum at retirement. You may retire at 55 or 65. Now, you will have to have that within your within the question that you're given. They'll have to provide you with the present value of the tax-free lump sum. And in this particular question, as we're told, there is no present value. There's no tax-free lump sum. She doesn't have a private pension, etc. So, in effect, what we know from that, or what we can gather from that, is that the increased basic is going to be adjusted upwards by €10,000 up to, as you see here, 36,225, because those two conditions are not in play. Okay. Now, if we move down to the SCSB, again, it looks a little bit more complicated than it is. We should know that the formula itself is in the tables, so we can just pick that up from the tables. It centers around several things. Excuse me. The first one is A, which is, in this particular case, or at least they call it A, is the average annual emoluments in the past 3 years. Now, let's just think about that. Really, what we're being asked to do is to go from the date of termination of her employment backwards. That is the date of termination of employment. So really, we've got to go backwards from there 3 years, not from the end of the previous tax year. And what they will always do, I would suggest, is to give you the salary information in tax years. For example, 31st of December 13, 31st of December 12. Those are easy to deal with. The problem with this one is that we've got to cut off, because in effect, we have 4 months worth here. We have 12 months worth here, 12 here. What does that leave us needing? It leaves us needing 8, because in all, we have to have 36 months, or indeed 3 years, to the date of termination. And this is where, a fair amount of work is required. And this is what they will do in the exam, I would suggest, unless it's a multiple choice question and they have to give you the figures because of the amount of time available. So what we get here by prorating the salary is this figure of 89. We simply take the average, because that's what A is, as we saw above. It's the average over the past 3 years to the date of termination, and we get 29,956. The next thing that we need to do is to take B, or in this case, the number of complete years of service. Now remember, it is complete years. It's not part years. So this is important. Apologies for that. This is important. It's complete years, and it's 21. Forget about the 11 months. Let's just put that into the question, and we'll see that we come out with, given the fact that C, or the present value of the lump sum, is in effect 0, and we saw that above because the conditions didn't apply in the increased basic. We're just really slotting in the figures into the question, and that will give us this value here, 41,938. So what we've got so far is 3 values, 1 for the basic exemption, 1 for the increased basic, and 1 for SCSB. We've got to take the highest, and the highest in this case is clearly the SCSB amount of 41,938. What do we then do? Well, we go back up here to where we listed each of the items, and you remember that the figure that we had for the taxable lump sum was 44. So that's the amount that we have to compare to the highest of the 3 exemptions. So if we take 44,200, if we bring it down here, what you'll see quite clearly is start with 44, take off the highest of the 3, then we get 2262, and that is the amount that's taxable. You remember from the requirements to the question, if I move back up here, it said, calculate the taxable lump sum on the termination, clearly stating the tax treatment of each element. So really what we've done is we've simply taken the 4 payments, and we've really just sort of, split them into 3 parts, As we said, we've got exempt, we've got fully taxable, and we've got partially exempt. And that covers that part A in effect, and that's 7 marks. So hopefully that made sense. Let's move on to part B. Now remember, this is where the bulk of the marks were. There was a lot of marks here. I think it was around about 16 or thereabouts. So the danger in this sort of question is, well, not getting your figures out for part A quickly enough. And the way that you're going to get fast and improve your speed on that area, obviously, is to do as many questions on termination as you can. All of them, do them more than once for sure, and then you'll get a fix on what I refer to in class as the steps that you need to go through to get to the right answer. The important thing to do, obviously, is to get an answer. We need a figure for part A as quick as we can. So for this question here, for this element of the question, part B, this is an income tax computation. Now, I always like it when I get income tax computations, or even capital gains tax computations, or really any sort of computation in a question. And the reason for that is I know that there are a lot of marks that I can get for really doing very little. And it's important within an income tax computation question to make sure that you get the easy marks. Don't avoid the easy marks. Don't focus in on the difficult marks. The difficult areas, what you have to do is to make decisions. Don't dwell on them, make decisions. If the marks for this area are 16, we only need 8 to pass it. And 8 is very doable, particularly if you get most or indeed all of the easy marks. Now, when I say easy marks, you know what I'm talking about. I'm talking about things like tax credits. I'm talking about things like simply including the salary that's given in the question. Okay, and I'll work down this question now and show you exactly what I mean. So we know we've got an income tax computation. We know that it's joint assessment. That means that we've really got one computation for Susan and Charlie, okay? Because they're a married couple and they've in effect elected for joint assessment. So let's deal with Susan first. What we'll see is they simply include the income in the question. Here we have Schedule E first. We were given this figure. Yeah, so it's just a question of taking it from the question and putting it into the answer. We see that the lump sum taxable here from A is 2262. That's the figure that we've just calculated here, as you'll recall, this one here. Okay, so we've got those two figures. What I would have been inclined to do here is to perhaps include the exempt statutory redundancy, just so the marker knows that I know what I'm talking about in relation to exempt items. So I would have perhaps included just a line maybe here saying, stat redundancy NA, yeah, or exempt, just so that I make sure that the marker knows what that I know what I'm talking about. So there's Susan's income. Nothing more to deal with her in relation to her. Let's deal with Charlie now. Again, very, very easy marks here. Schedule E, that's the salary that's given in the question. All that we're doing is really cutting and pasting it into the body of the income tax comp. Now, the benefit in kind, you remember that we were given a couple of different values. If we look down at note 1, down the bottom here, you'll see that it's nicely annotated. Here's the notes to the income tax computation. You'll see that they have benefit in kind on car. Now we know that the normal benefit is 30% times the OMV, the original market value. So we don't want the market value, the current market value, we want the original market value. The original market value was 36. So all that we're doing is we're simply taking 30% times 36 to give us 10.8. Now, in the question, it said, I think that the mileage was 20,000, of which 20% was business. Now, that makes it, excuse me, in effect, 4,000 business miles. Now, that's nowhere near the level of 24,000 that we need to reduce that percentage, to reduce the 30%. Now, we're only reducing that if we have in excess of 24 km in terms of mileage. So in this case, it's not relevant. So also remember, as I said in the question, although it's not relevant here, that when we see a car BIK, it's always better, in my view, to go through those 5 steps. And you should remember those 5 steps from your study. Start with the OMV, annualize the mileage, etc., etc. Okay. Now, what we have here in terms of this 4,800 is just literally the contributions. So you should remember from your studies that that is step 5. So literally we've got one less the other here, giving us the taxable figure of 6,000. Okay. So that's the figure that they include as the benefit in kind above, a la here. Okay. So this is in effect Charlie's taxable income from Schedule E. The next thing that they do, when we have gross income dealt with, we deal with deductions. Obviously, case 3 and case 4 are to come. So we've got pension contributions here based on, in effect, net relevant earnings. Now, we have a note, which we'll look at in a minute. Now, where we see pension contributions in a figure for someone who is in an occupational pension scheme, we should be aware of the fact that basically the amount that they can contribute is based on their age times their NRE. Now, for this individual, because they're in an occupational scheme, and we know that their age is 49, we can look at the tables and say, okay, he's in an occupational scheme, so basically his NRE is basically his salary, including benefits in kind. He's 49, therefore looking at the tables, the maximum amount that he can contribute is 25%. So 25% times the NRE gives us 16. Now we see that that 16 figure is actually higher. It's greater than the amount that he did contribute. Now, as I said in class, I would expect them to do it the other way. I would expect them to provide you with a pension contribution figure that's higher than what they can do, which would simply mean that we roll forward or carry forward any excess to the following year. So because of this situation, because the value that he can contribute is more than the value that he has contributed, we have simply an issue to deduct what he has contributed. Okay, so we'll see above that figure of 15,000 is very simply just the full amount that he has contributed towards the pension. The next thing that we do for Charlie is very, very straightforward. We're just looking at other income, i.e. any interest income under Schedule D. And those two bits there, we have case 3 and case 4, UK versus Irish interest, the 800 and the 2000. Now remember that Irish interest or interest from an Irish institution is grossed up, at 41%. In other words, it is received after 41% tax has been deducted. So what do we do to get it into the answer? We must gross it up, So in effect, if the net amount is 1180, we simply either multiply by 0.59 or multiply by 100 divided by 0.59, and that gives us the 2000. The key trick with the UK interest, and what we've got to remember, this is easy marks, is the UK interest is received gross. Okay, so there's the two figures. Now, do remember that for the DIRT income, in other words, for the Irish interest income, the Irish interest really has 3 impacts on a income tax computation. We're seeing here the first impact. In other words, let's include the income gross. And we'll see below that there are 2 other impacts on the computation. So watch for that and watch for the difference between the treatment of Irish interest subject to DIRT and UK interest, which is not subject to DIRT. Okay, next area here for us is the Schedule F income. And that is basically just dividends. Again, we're just looking to put it in gross. So we know that dividends will have DWT at 20% deducted. So we simply just gross up that 1,500 to 1,875. Next element here, when we get to total income, is we think about charges. We had a deduction above. Let's think about charges here, and that's where that covenant becomes relevant. Now, with a covenant, what is it? Well, all that we're saying is that Charlie has a promise to pay his father a certain amount of income every year, so that he is simply agreeing to pay his father, his widowed father, a certain amount of income. Now, the key trick here, because of the fact that the total amount was in fact 6,000. In other words, the covenant per year that he's agreed with his dad was 6,000. Okay, but there is a restriction on 5% of total income. So basically, this restriction here is basically based on 5% of that figure. Okay. So that's where the deduction comes in, or indeed the charge comes in. For charge, basically the same as a deduction. We're going to reduce income by it, okay? Reduce gross income. Now, you'll note that this area of the covenant does impact on the bottom of the comp as well, and I'll explain that when we get to it. So the covenant goes in as a charge or a deduction in effect, but it also impacts down below as well. Okay, the next thing that we see is, well, really another deduction of sorts, this PHI, in other words, this permanent health insurance. And we should remember from our studies that there's also a little quirk with that, and it is really, it is really that there's a 10% limit based on total income. Notice the difference here. Here with the covenant, we've got a 5% restriction. With PHI, we've got a 10% restriction. So these are little quirks and things that the examiner will put in the question just to try to throw you off balance. Quite a few things for you to remember, but the more questions that you do, the more you'll be able to deal with these quite quickly and easily. So don't be concerned. Okay, so we get to taxable income. We know that in the taxable income area, what we're always thinking about really when we get to taxable income is, what is the status? Yeah, the status of the individual. In other words, broadly speaking, really, are they single? Yeah, or are they married? We know that we have one parent family as well. So in this particular case, really what we've got is a married couple. Yeah. So that in effect, we know that the starting point is going to be 41.8. It has to be 41.8. So 41.8 times 20, and this figure of 12,462, what you'll see if we move back above, is basically just the income relevant to Susan as the extension in the band. So you remember where we have a married couple, and one of their incomes is less than 23.8, we extend the basic married band of 41.8, we extend that by the value of the income. And that's what we're doing here in this area. Apologies. That's what we're doing here in this area of the question. We're really just extending the basic rate band by the value of Susan's income. So Susan's income is going to be all at 20%. And any difference over and above that is going to be at 41%. And that's where the 2.8 comes in. Okay, so that's where the 2.8 is being taken at 41% to give us this figure here. Okay, and then over and above that, oh, sorry, tell a lie, actually, my mistake there. This 2,800 is the dirt income plus the UK interest. Okay, so I remember that we said above that where we have interest from any source, there's going to be an impact obviously below in relation to the bands, and there can be an impact down below in relation to the tax credits. So this 2,800 is basically the UK interest plus the dirt income being taxed at 41%. Sorry for confusing you there. In addition to that, in terms of the additional income outside of what we've detailed above as 41.8 plus 12,462, this balance here, is basically the balance of the income that has to be taxed at 41%, and that's where we get the 1801. So just to recap then, in case I have confused you, we've got a married couple, okay? We know that with a married couple, the basic 20% band is 41,800. So that's where we get that figure of 41.8 times 20%, giving us 8,360. What do we then do? Well, we say, the second person's income, in this case the wife, Susan, is it in excess of 23.8? It isn't. In that case, we increase the 41.8 by the value of the second person's income, which in this case is 12462, and we tax that at 20%. Now, the next thing that we do is to look at the interest income. You remember in class that I said that income is what we call ring-fenced. Now, what income is ring-fenced? Well, dirt income, so income or interest income from an Irish banking institution or building society. And in addition to that, any interest income from a UK bank or building society. So that income has to be taxed at 41% regardless in all circumstances. Okay, so that's the second hit, I guess, for the DIRT income. And you'll see that down below in the tax credits, we also have another or a third hit on the income tax comp for the DIRT income. Okay, so hopefully I've made sense there if I didn't before. So our total tax due, is 13,801. That's the total amount before any credits. What do we do next? We deal with what we call the non-refundable tax credits. Now remember, this is a married couple, so they must have a married couple's allowance. They're both employed, so they've got to have, they refer to it as PAYE, maybe we should refer to it as the employee credit. They must both have the employee credit. And then in addition to that, they've included here the DIRT as non-refundable. Why? Because neither of these individuals are over 65. So in fact, it is a non-refundable credit. And again, that is, remember, our third hit. That's the third hit for the DIRT income on the income tax comp. The first hit was included as gross. The second hit was ring fence it and tax it at 41%. The third hit is that it comes in as a tax credit or non-refundable tax credit. So that gives us the figure of 6381 for the total for non-refundable tax credits. Then let's deal with the refundable ones. Now again, easy marks here. These are given in the question. 6,000 for Charlie, 1,500 for Susan. Nothing for us to do here except literally remember, but hopefully we've annotated the question with those letters TC. So when we get to this area, let's go back to the question and let's just pick up all the TCs, all the tax credits, okay? Easy marks, probably half a mark, maybe even 1 mark. I'd say more likely half a mark for each of these items. Now, the third one here under the refundable credits is dividend withholding tax. Now again, when dividends are received by an Irish resident individual, they're received after a deduction of 20%. So all that we're doing is including them gross above as gross income and then just allowing for the 20% credit. Note that obviously DWT income, Schedule F dividends, are just taxed as normal. Yeah, they're not ring fenced, they're just taxed at either 20 or 41. So that gives us 1494. Now you'll note here that they've got add on the tax due on the covenant. Yeah, so add on the tax due on the covenant. Now, the reason that they do that is that you'll remember that we spoke above, the covenant was deducted, yeah, as a charge. Yeah, so it was deducted as a charge subject to a restriction of 5% of total income. So basically what we did was we included his gross income, yeah, and then we said, okay, he has a covenant to his father, a promise of 6,000 euros per annum to his father. But in this case, and indeed in all cases, that covenant or the amount that you can deduct in your income tax computation is restricted to 5% of total income. So in this case, the value of the covenant that he could deduct was 2684. Now, if you think about it, covenants or the requirements when you pay out a covenant to another individual, the requirement is that you deduct tax at source. In other words, that Charlie, before he pays the money out to his father, actually pays him only 80%, not 100%. So in effect, what Charlie is doing is taxing the covenant at source. In other words, keeping income tax back from the covenant. Yeah, and because of that, what he is required to do in his income tax computation is really add on the value that he has restricted the covenant by. So in other words, he is adding back the tax that he held back, which is in effect due. So in effect, that is a payment due over to the revenue, and that reduces the repayment that is due to him. That's where we get 1494 less 537. So the net refund due is actually 957. Okay, so do look at that area of covenants within your study text. It's only small, it's minor, it's not the end of the world if we haven't got 100% fix on it. It's a little bit sort of odd, I guess, but any problems, let me know in class. So the last part of the question was really the USC, which I'm not going to deal with here. I'm hoping that my run through there has given you a good feel for that. You know, what do we learn from this question in terms of sort of broad issues? Well, I think for me, what we learn is that, taxable termination payments or indeed termination payments period are important. That's a core area of the F6 Schedule E syllabus. Other than that, we learned that in Part B, the income tax computation, there were a lot of very easy marks, marks for doing nothing, marks for just putting a salary from the question into the comp, or putting a tax credit from the question into the comp. Obviously, there were some difficult marks. Maybe Part A, the termination, was a little bit tricky. There were some issues in relation to restrictions on charges and deductions, like, for example, the covenant. But, to get 50% of the marks, I don't think is overly difficult if you have a good grasp of the basics. Okay, so hopefully that was helpful. Any questions, do approach me in class and I'll clarify for you. Okay, many thanks.